What if I told you that while QQQ surged 5.9% in October alone, 3 other growth ETFs are playing an entirely different game with the same mega-cap tech stocks? One charges just 0.04% in fees, while another bets everything on Tesla and disruption. By the end of this video, you'll discover which growth ETF actually matches your investment DNA. Because here's the truth most investors miss. It's not about which ETF is best, it's about which one fits your strategy. Let's dive in. Quick favor, hit like and subscribe right now, so YouTube shows this to more people who need to see it. Let's start with the benchmark everyone knows, the Invesco QQQ Trust. As of October 29th, QQQ is trading at $635.77, commanding a massive $402.82 billion in assets under management. This makes it not just the largest growth ETF, but one of the most liquid investment vehicles on the planet. When you buy QQQ, you're buying the NASDAQ 100, which means you're getting 102 of the biggest non-financial companies in America. The top 3 holdings tell the story. Nvidia at 9.58%, Apple at 8.26%, and Microsoft at 8.24%. Together, just these 3 tech giants represent over a quarter of your investment. The fund is absolutely dominated by information technology at 64% of the portfolio, with consumer discretionary and communication services making up most of the rest. Here's what's exciting. QQQ just broke through the $630 resistance level, and it's trading near its 52-week high of $638.18. Even more interesting, the fund just announced a dividend increase to 0.694 per share, up from the previous 0.59. For a growth fund, that's actually meaningful. The expense ratio sits at 0.2%, which sounds small until you compare it to what's coming next. QQQ represents institutional-grade exposure to American tech dominance, and with a 30-day SEC yield of 0.44%, you're getting some income while you wait for growth. But here's the question. Can you get the same exposure for less? Enter the Vanguard Growth ETF, ticker VUG. Think of this as QQQ's bigger, bolder cousin. Trading at $502.07 as of October 28th, VUG has climbed 4.7% since September 30th, and it manages $198.10 billion in assets. Here's where it gets interesting. VUG doesn't just match QQQ's mega-cap tech exposure, it amplifies it. Nvidia represents 12.02% of the portfolio, Microsoft 10.70%, and Apple 10.47%. Do the math and you'll see that VUG's top 3 holdings alone represent over 33% of your investment. The fund holds 163 companies total, and the top 10 positions account for 59.69% of the entire portfolio. This is concentration with purpose. VUG's portfolio PE ratio sits at 39.78, higher than QQQ's 32.09, which tells you investors are paying a premium for these growth stocks. But here's the kicker. VUG charges just 0.04% in expense ratio. That's 5 times cheaper than QQQ. Over 10 years, that difference compounds dramatically. VUG also comes with a beta of 1.17, meaning it's about 17% more volatile than the overall market. That's the price you pay for amplified growth potential. The fund pays a trailing 12-month dividend of $2.05 per share, with quarterly distributions hovering around 50 cents. For investors who believe the mega-cap tech trade has legs, VUG offers the most concentrated exposure at rock-bottom prices. It's 99.71% invested in U.S. companies, so you're making a pure domestic bet. Now let's talk about the diversification master, the SPDR portfolio S&P 500 Growth ETF, ticker SPYG. Trading at $106.23 as of October 30th, with a net asset value of $106.19, this fund trades essentially at fair value with almost no premium or discount. SPYG manages $43.24 billion and holds 218 companies, making it the most diversified of all 4 ETFs we're discussing. But here's the fascinating paradox. Despite having the most holdings, SPYG actually has the highest concentration in Nvidia at 14.34%. Microsoft comes in at 6.39%, and Apple at 5.46%. The fund's top 10 holdings represent 54.98% of assets, and it sports a P/E ratio of 36.39. SPYG delivered a 26.48% return year to date, and its one-month NAV gain was 2.27%. The expense ratio matches VUG at just 0.04%, making it one of the cheapest ways to access growth stocks. What sets SPYG apart is its sector balance. While still tech-heavy with technology services at 30.64% and electronic technology at 28.77%, you also get meaningful exposure to finance at 11.21% and retail trade at 8.12%. The dividend yield sits at 0.54%, the highest among these four ETFs. SPYG essentially cherry-picks growth stocks from the S&P 500, giving you 218 positions that have been screened for growth characteristics. For investors who want growth exposure but also want to sleep at night, SPYG offers the sweet spot between concentration and diversification. And now, the wild card, ARK Innovation ETF, ticker ARKK. This is where things get aggressive. As of October 29th, ARKK trades at $89.45 with $8.63 billion in assets. But look at that 52-week range, from a low of $38.57 to a high of $92.65. This fund has more than doubled from its lows, and that volatility is by design. ARKK is actively managed by Cathie Wood and her team at ARK Invest, and it holds just 48 companies. This is pure concentrated conviction. Tesla dominates at 12.35% of the portfolio, followed by Coinbase at 6.01%, Roku between 5.31% and 6.07%, and CRISPR Therapeutics at 5.05%. The top 10 holdings represent 56.27% of assets, and the portfolio P/E ratio is an eye-watering 52.62. Investors are paying more than 50 times earnings for these companies because they're betting on future disruption, not current profits. ARKK's themes are clear: genomics, artificial intelligence, blockchain, autonomous mobility, and energy innovation. You're getting exposure to Shopify, Tempest AI, Robinhood, Roblox, and Palantir. The fund is 79% invested in U.S. companies, with meaningful international exposure, including 5.15% in Canada and 4.41% in Switzerland. Here's the cost. RKK charges 0.75% annually, which is 3.75 times more expensive than VUG or SPYG. The fund also has a portfolio turnover rate above 40%, meaning Cathie Wood is actively trading these positions. ARKK pays no regular dividends because it's designed purely for capital appreciation. This is not a fund for the faint of heart. Let's talk about something most investors ignore until it's too late: expense ratios. Imagine you invest $10,000 in each of these funds, and they all grow at 10% annually for 10 years. With VUG or SPYG at 0.04%, you'd pay roughly $400 in total fees over that decade. With QQQ at 0.2%, you're looking at about $2,000 in fees. But with ARKK at 0.75%, you'd pay approximately $7,500 in fees over 10 years. That's the difference between paying for a nice vacation and paying for a used car. Compound that over 20 or 30 years, and the gap becomes enormous. This doesn't mean ARKK is bad. It means you need ARKK to significantly outperform to justify that cost. Active management has a price, and you're paying it every single year regardless of performance. So let's compare performance and risk directly. Holdings count ranges from ARKK's concentrated 48 stocks to SPYG's diversified 218. Top 10 concentration is remarkably similar across all four, ranging from 52% to 60%. P/E ratios tell the valuation story. QQQ at 32.09 is the most reasonable. VUG at 39.78 is paying up for quality growth. SPYG at 36.39 sits in the middle, and RKK at 52.62 is making a speculative bet on future earnings. All four funds are heavily concentrated in the same mega-cap names, which means they'll often move together during tech rallies or corrections. The key differences are in the degree of concentration, the cost you pay, and the specific bets beyond the top 10. RKK's 79% U.S. exposure gives you more geographic diversification than the others, but it also introduces unique risks from smaller, less established companies. So who should choose which ETF? If you're a conservative growth investor who wants mega-cap safety with the lowest possible fees, VUG or SPYG are your answer. VUG if you want maximum concentration in the big three tech giants, SPYG if you want broader diversification with 218 holdings. If you're a benchmark tracker who values liquidity above all else and wants the standard institutional growth exposure, QQQ is still the king with over $400 billion in assets. If you're an aggressive innovator with high risk tolerance who's willing to pay for active management and can stomach 50% drawdowns, RKK offers exposure to disruptive themes you won't find in index funds. If you're cost-conscious but still want heavy tech exposure, VUG delivers concentrated mega-cap growth at just 0.04%. If you want balanced growth with the most holdings and the highest dividend yield, SPYG is your fund. But let's be clear about the risks. All four of these ETFs are heavily weighted in the same companies. NVIDIA, Microsoft, and Apple appear in the top 5 of every single fund. That means during a tech correction, all four will likely fall together. RKK's extreme volatility means it can double, but it can also get cut in half as we saw in the 52-week range. Expense ratios compound over decades, and that 0.75% ARKK fee will cost you significantly more than you think. There's no single best choice here because the best choice depends entirely on your goals, timeline, and risk tolerance. If you're investing in a taxable account, ARKK's 40% turnover rate creates more taxable events than the passive index funds. Here's the bottom line. QQQ at $635.77 remains the liquid institutional-grade benchmark, with $402.820 billion proving its dominance. VUG at $502.07 amplifies mega-cap tech concentration at the lowest cost. SPYG at $106.23 offers 218 holdings for maximum diversification while still delivering growth. RKK at $89.45 makes concentrated bets on disruptive innovation with active management. This is educational content only, not financial advice. Do your own research, understand your risk tolerance, and maybe talk to a financial advisor. Which ETF matches your strategy? Drop a comment below and let's discuss. If you found this data-driven analysis valuable, subscribe for more investing breakdowns. Remember, in 2025's growth race, it's not just about returns, it's about finding your personal risk-reward balance. Thanks for watching.